Dornbusch download, David, number 117. Ladies and gentlemen, I have a real-life economist with me today, David Bassanese from Better Shares. David's Better Shares chief economist. We're doing an exchange-traded funds seminar at the Empire today, and we're recording that one as well, so that'll be up on the website. We'll look at this address here. We'll put that up there so you can watch it, and in that you're talking about the year going forward, David,
the year of Trump. I mean, sort of what's happening, how the markets are looking at Trump, and what it probably means for the markets over the coming year. Talking about the Australian economy over the coming year as well. Lots of thrills and spills to look forward to, I think, in the market.
I think so, yeah. One thing we spoke about, Michael and I spoke about a few weeks ago, was the year of the sevens, David. You know, 87 and then 97 with the Asian financial crisis. 2007 being the GFC.
Yes.
And 2017. So I thought I'd just pick your brains from an economist's point of view. What's the potential, what areas should investors look at, for potential problems in 2017?
Well, there's a few. Obviously, Donald Trump is a bit of a risk factor. I mean, the markets initially now have rebounded out of relief that at least since the election he seems a bit more reasonable. But he is, though every day there's something new, so it's still a bit of a wait and see in terms of how Donald Trump will be as president. That's a risk factor. To what extent he engages in a trade war with Asia, as he's threatened to do, that's obviously going to be quite negative. The other issue in Europe, I mean, there's a number of elections in Europe next year. In the Netherlands, we've in fact got an important Italian constitutional referendum on December 4. Now, if that doesn't pass, there's a risk of a bring forward of Italian elections to next year as well. And so we've got Italy, Netherlands, Germany and France next year, all with populist parties potentially having an important role to play in the next government and anti-EU policy. So, again, there's a risk of a 2012 type European crisis as well.
Which, you weren't supposed to put twos in there, it's sevens.
Well, it will happen next year, so 2017,
Yeah, it is very interesting. So, in your mind, what's the chances of Italy leaving the EU?
Look, I don't think it will leave the EU in the end of the day. I think the population basically want their cake and eat it too. They want to stay in the EU, but they want to be able to, run large deficits and not conform to the EU. So they'll try to do that. But I mean, I guess the problem for the markets is that there's going to be a lot of water to flow under the bridge before there's an election, a possible referendum. I mean, the risk is maybe not leaving the EU, but leaving the euro. And then there's a possibility of like the disintegration of the single currency experiment.
That would throw a few cat amongst the pigeons, wouldn't it?
It would be, because I mean, it would, the deficit, it just open up a massive can of worms for Italy and also for the rest of Europe. So there's a lot of, I think that's obviously a major risk factor next year.
Yeah. Very interesting. Interest rates in Australia next year?
Look, I still think if anything they're going to go down rather than up, but my base case at the moment is going to remain on hold. But we would basically need to see inflation, which is currently underlying inflation running below 2%, picking up to 2% by next year. And the RBA, if it doesn't happen, and I think there's a risk that it may not happen because wages growth is still quite low, the RBA will be under the gun to possibly cut rates again, probably not February, but possibly by May. So again, the bias, I think, is still to the downside for interest rates.
Very good. Even though the 3 and 5 year rates, they're sort of creeping up, aren't they?
I mean, long-term bond yields globally are starting to rise, because inflation's starting to pick up in the United States, and you've got Donald Trump promising to widen the US budget deficit, cut taxes, and you've got the Federal Reserve starting to raise rates again. Probably next month, and markets now virtually got 100% probability that the Fed will raise rates in December. You're looking at least 2 rate rises in the US next year. So bond yields have been incredibly low for so long, and there's a backup in those yields are inevitable, and that's why you're seeing fixed rates, I think, reflecting that.
Yeah, okay. And those bond yields, how much impact does that have on our banks? Because they would get a lot of funding from overseas.
Yeah, in the I mean, their sort of longer term funding costs will rise, and so it's going to add to their funding pressures, and so it will mean should the RBA cut rates, they may not pass it on in full again, as we've seen in the past, or in fact, possibly raise mortgage rates if the RBA doesn't cut rates. So there will be pressure for those extra funding costs to be reflected in their mortgage rates. Yeah, so there is a risk if bond yields keep rising that lending rates in the country start creeping up early next year.
Yeah. Okay. So a few issues there, and you'll cover more off this afternoon.
Yes.
Yeah, download our other presentation and go from there. Very good. Thanks, Dave.
Thank you.